private capital. The term itself continues to elicit admiration, envy, and fear in the hearts of many public company CEOs. Private equity firms have amassed massive and contentious sums in recent years while pursuing ever larger acquisition targets. According to Dealogic, a firm that tracks acquisitions, the global value of private equity buyouts larger than $1 billion increased from $28 billion in 2000 to $502 billion in 2006. Despite the fact that the private equity environment has become more difficult due to rising interest rates and increased government scrutiny, this figure reached $501 billion in just the first half of 2007. The reputation of private equity firms for dramatically increasing the value of their investments has contributed to this growth. High-powered incentives for both private equity portfolio managers and operating managers of businesses in the portfolio. Aggressive use of debt, which provides financing and tax advantages. A determined focus on cash flow and margin improvement. And freedom from restrictive public company regulations are all factors that contribute to their ability to achieve high returns. However, the fundamental reason for private equity's growth and high rates of return has received little attention, perhaps because it is so obvious. The firm's standard practice of buying businesses and then selling them after guiding them through a transition of rapid performance improvement. That strategy, which combines business and investment portfolio management, is central to private equity's success. Public companies, which invariably acquire businesses with the intention of keeping them and integrating them into their operations, can benefit from this buy-to-sell strategy. To do so, they must first understand how private equity firms use it so effectively. The sweet spot for private equity. Buying to sell cannot be an all-purpose strategy for public companies. It makes no sense when an acquired company will benefit from significant synergies with the buyer's existing portfolio of companies. It's certainly not the way to profit from an acquisition whose main selling point is the prospect of long-term organic growth. However, as private equity firms have demonstrated, the strategy is best suited when buyers must take outright ownership and control in order to realize a one-time, short to medium-term value creation opportunity. Such an opportunity typically arises when a company has not been aggressively managed and is therefore underperforming. It can also be found in undervalued businesses where the potential is not readily apparent. In those cases, once the changes required to achieve the increase in value have been implemented, usually over a 2 to 6 year period, it makes sense for the owner to sell the business and pursue new opportunities. The advantages of buying to sell in such situations are obvious, but, once again, are frequently overlooked. Consider an acquisition that quickly increases in value, earning an annual investor return of, say, 25% for the first 3 years, but then earns a more modest, but still healthy, return of, say, 12%. A private equity firm that buys to sell and sells it after 3 years will earn a 25% annual return. A diversified public company that achieves identical operational performance with the acquired business, but has purchased it as a long-term investment, will earn a return that approaches 12% the longer it owns the business. Holding on to the business after the value-creating changes have been made dilutes the final return for the public company. Private equity firms prospered in the early years of the current buyout boom primarily by acquiring non-core business units of large public companies. Those businesses had frequently suffered from neglect, unsuitable performance targets, or other constraints under their previous owners. Even if well managed, such businesses may have lacked an independent track record because the parent company had integrated their operations with those of other units, making it difficult to value the businesses. According to Dealogic, sales of unwanted business units by public companies were the most important category of large private equity buyouts until 2004, and the leading firm's widely admired history of high investment returns is largely due to acquisitions of this type. Private equity firms have recently shifted their focus to the acquisition of entire public companies in order to achieve greater growth. For more information, see the exhibit, Private Equity's New Focus. Private equity firms now face new challenges as a result of this. Better corporate governance or hedge fund activism have frequently resulted in easily realized performance improvements in public companies. For example, a hedge fund with a significant stake in a public company can exert pressure on the board to make valuable changes such as selling unnecessary assets or spinning off a non-core unit without having to buy the company outright. If a public company must be taken private in order to improve its performance, the necessary changes are likely to put a private equity firm's implementation skills to the test far more than the acquisition of a business unit. When KKR and GS Capital Partners, Goldman Sachs' private equity arm, acquired Siemens Wincor Nixdorf unit in 1999, they were able to work with the incumbent management and follow its plan to increase revenues and margins. KKR, Bain Capital, and Vornado Realty Trust, on the other hand, have had to replace the entire top management team and develop an entirely new business strategy since taking Toys R Us private in 2005. Furthermore, because private equity firms only buy to sell, they are not enticed by the often enticing prospect of sharing costs, capabilities, or customers among their businesses. Their management is lean and focused, avoiding the waste of time and money that corporate centers frequently incur when responsible for a number of loosely related businesses and wishing to justify their retention in the portfolio. Finally, the relatively quick turnover of businesses required by a fund's limited life means that private equity firms gain know-how quickly. From 2001 to 2006, Permira, one of Europe's largest and most successful private equity funds, made more than 30 significant acquisitions and more than 20 disposals of independent businesses. Few public companies amass this level of expertise in purchasing, transforming, and selling. What can public companies do? As private equity has grown in popularity, public companies have shifted their focus away from value creation acquisitions like those made by private equity. Instead, they have focused on synergistic acquisitions. Conglomerates that buy unrelated businesses with the potential to significantly improve performance, such as ITT and Hansen, have fallen out of favor. As a result, private equity firms have faced few competitors for acquisitions in their preferred market. Given the success of private equity, it is time for public companies to consider whether they should compete in this space more directly. Conglomerates that acquire unrelated businesses with significant upside potential have fallen out of favor. As a result, private equity firms in their sweet spot have faced few competitors. We see two possibilities. The first option is to use the buy-to-sell model. The second is to adopt a more flexible approach to business ownership, in which a willingness to hold on to an acquisition for the long term is balanced by a commitment to sell as soon as corporate management believes it can no longer add value. Purchase in order to resell. Companies that want to try this approach in its purest form face significant obstacles. One is the difficulty of changing a corporate culture that is ingrained with a buy-to-keep strategy. This necessitates a company not only abandoning deeply held beliefs about the integrity of a corporate portfolio, but also developing new resources and, in some cases, drastically altering its skills and structures. A tax barrier also exists in the United States. Whereas private equity funds organized as private partnerships pay no corporate tax on capital gains from business sales, public companies pay the normal corporate rate on such gains. This difference in corporate taxes is not offset by lower personal taxes for public company investors. Higher taxes make public companies less appealing as a vehicle for buying and selling businesses after increasing their value. Previously, public companies in Europe faced a similar tax barrier, but it has been eliminated in most European countries over the last 5 years. This significantly improves the tax position of European public companies when buying to sell. It should be noted that two tax issues have received public scrutiny in the United States. The first question, whether publicly traded private equity management firms should be taxed as private partnerships or as public companies, is closely related to the one we raise. The second question is whether the profits earned by private equity firm partners on the sale of businesses in funds managed by them should be taxed at the lower rate for personal capital gains or at the higher rate for ordinary personal income. Despite the challenges, some publicly traded companies have successfully developed a buy-to-sell business model. Indeed, two long-standing players in mid-market buyouts, those valued between $30 million and $1 billion, are public companies. American Capital Strategies, with a recent market capitalization of around $7 billion, and 3i, based in the United Kingdom, with a market capitalization of around $10 billion. Both companies found ways to avoid the corporate capital gains tax, which the UK only abolished in 2002, by using unusual organizational structures, a business development company, in the case of American Capital, and an investment trust, in the case of 3i. However, those structures impose legal and regulatory constraints on the firm's operations. For example, there are limits on the ability of business development companies to acquire public companies and the amount of debt they may incur. Because of these constraints, such structures are unappealing as vehicles for competing with private equity, at least for large buyouts in the United States. With the elimination of tax breaks across Europe, a few new publicly traded buyout players have emerged. The two largest are two French firms, Wendel and Eurazeo. Both have seen impressive returns on their buyout investments. Over the last 5 years, Eurazeo, for example, has achieved an average internal rate of return of 53% on its 3 large buyout exits: Terreal, Eutelsat, and Freikin. In the United States, where private companies, like private partnerships, can choose not to pay corporate taxes, Platinum Equity has become one of the country's fastest-growing private companies by competing to buy out subsidiaries of public companies. With the elimination of tax breaks across Europe, a few new publicly traded buyout players have emerged. The emergence of public companies competing with private equity in the market to buy, transform, and sell businesses could provide significant benefits to investors. Private equity funds are illiquid and risky due to their reliance on debt. Additionally, once investors have given their money to the fund, they have no say in how it is managed. Investors should expect a high rate of return in exchange for these terms. However, while some private equity firms have achieved excellent returns for their investors, the average net return fund investors have made on U.S. buyouts over the long term is roughly the same as the overall return for the stock market. Meanwhile, private equity fund managers have earned extremely attractive rewards with little initial investment. They have structured agreements so that a large portion of the gross returns, around 30% after management and other fees, flows to them as compensation for taking the initiative in raising money, managing investments, and marketing their benefits. That figure does not include any returns on their personal investments in the funds they manage. Public companies with a buy-to-sell strategy that are traded on the stock market daily and answerable to stockholders may offer a better deal to investors. Where might a significant number of publicly traded private equity competitors emerge? Even if they recognize the benefits of private equity in principle, few of today's large public industrial or service companies are likely to implement it. Their investors would be concerned. Furthermore, few corporate executives would easily transition into a more investment-focused role. Private equity partners are typically former investment bankers who enjoy trading. Most top corporate executives are former business unit heads who enjoy managing. However, public financial firms may find it easier to implement a buy-to-sell strategy. More investment firms, like Wendel and Eurazeo, may switch to a private equity management style. More private equity firms may decide to float an entire investment portfolio on public markets, as Ripplewood did with RHJ International's initial public offering on the Brussels Stock Exchange. More seasoned investment banks may follow in the footsteps of Macquarie Bank, which established Macquarie Capital Alliance Group, an Australian securities exchange-traded company that focuses on buy-to-sell opportunities. Furthermore, some experienced private equity managers may decide to raise public capital for a buyout fund via an IPO. These examples differ from the initial public offering of the firm that manages the Blackstone funds, but not the funds themselves, by the private equity firm Blackstone. Ownership is adaptable. A flexible ownership strategy may be more appealing to large industrial and service companies than buying to sell. Under this strategy, a company retains businesses for as long as it can add significant value to them by improving their performance and fueling growth. The company is equally willing to sell those businesses once that is no longer obvious. A decision to sell or spin off a company is viewed as the culmination of a successful transformation, rather than the result of a previous strategic error. At the same time, the company is free to keep an acquired business, giving it a potential advantage over private equity firms, which sometimes have to forego the benefits of holding on to investments for a longer period of time. A decision to sell or spin off a business is seen as the culmination of a successful transformation, rather than the result of a strategic blunder. Companies with a portfolio of businesses that do not share many customers or processes are likely to benefit the most from flexible ownership. Consider General Electric. Over the years, the company has demonstrated that corporate management can add value to a diverse set of businesses. GE's corporate center assists its businesses in developing general management skills, such as cost discipline and quality focus, and ensuring that broad trends, such as offshoring to India and the addition of service offerings in manufacturing businesses, are effectively exploited by all. Despite calls for GE to be broken up, the company's management has been able to create and sustain high margins across its portfolio, implying that limiting itself to synergistic acquisitions would be a mistake. Indeed, with its legendary management skills, GE is likely better equipped than private equity firms to correct operational underperformance. To reap the benefits of flexible ownership for its investors, GE would have to be wary of the risk of keeping businesses after corporate management could no longer add significant value. GE is well known for its annual practice of laying off 10% of its managers. To ensure aggressive investment management, the company could, perhaps less controversially, institute a requirement to sell 10% of businesses with the least potential for value addition every year. On frequent business disposals, GE would have to pay corporate capital gains taxes. We would argue that the tax constraints that favor private equity funds and private companies over public companies in the United States should be lifted. Nonetheless, even in the current tax environment in the United States, there are ways for public companies to reduce this burden. Spin-offs, for example, in which the parent company's owners receive equity stakes in a newly independent entity, are not subject to the same restrictions. Following a spin-off, individual shareholders can sell stock in the new enterprise with no corporate capital gains tax payable. We haven't come across any large public companies in the industrial or service sectors that explicitly pursue flexible ownership as a strategy for competing in the private equity sweet spot. Although many companies actively sell businesses, the goal is usually to focus an overly diversified portfolio and make it more focused and synergistic, rather than to realize value from successfully completed performance enhancements. Even acquisitive conglomerates that successfully targeted performance improvement opportunities, such as ITT and Hansen, were unwilling to sell or spin off businesses once their value could no longer be increased, making it difficult to sustain earnings growth. However, given the success of the private equity model, companies must reconsider the traditional taboos associated with selling businesses. Portfolio strategy selection and implementation. As we've seen, competing with private equity presents a significant opportunity for public companies, but it's not easy to capitalize on. Managers must be able to invest, both buying and selling, and improve operational management. The challenge is similar to that of a corporate restructuring, except it must be repeated repeatedly. After the exhausting work of a transformation is completed, there is no return to business as usual. Competing with private equity to create shareholder value makes sense primarily for companies that own a portfolio of unrelated businesses. You must ask yourself some difficult questions in order to determine whether it is a good move for your company. Can you identify and correctly value businesses that have room for improvement? A private equity firm may screen dozens of potential targets before closing a deal. Many businesses devote more resources to this than to anything else. Private equity managers typically have backgrounds in investment banking or strategy consulting, as well as line of business experience. To find new deals, they use their extensive networks of business and financial contacts, including potential bidding partners. Their ability to predict cash flows enables them to work with high leverage but acceptable risk. A public company that uses a buy-to-sell strategy in at least part of its business portfolio should assess its capabilities in these areas and, if lacking, consider whether they can be acquired or developed. Do you have the knowledge and experience to turn a failing business into a success? Private equity firms are known for assembling strong, highly motivated executive teams. Sometimes this simply means providing current managers with better performance incentives and more autonomy than they had previously. It could also imply acquiring management talent from the competition. Working with a stable of serial entrepreneurs, who, while not on the firm's staff, have successfully worked with the firm on buyout assignments more than once, could also be an option. Excellent private equity firms are also adept at identifying the one or two critical strategic levers that drive improved performance. They are known for having excellent financial controls and a relentless focus on improving the fundamentals of performance: revenue, operating margins, and cash flow. Furthermore, a governance structure that eliminates a layer of management. Private equity partners serve as both corporate management and the corporate board of directors, enables them to make big decisions quickly. Private equity firms gain experience with turnarounds and hone their techniques for increasing revenues and margins over the course of many acquisitions. A public company must determine whether it has a comparable track record and set of skills, and if so, whether key executives can be freed up to take on new transformation challenges. However, while some private equity firms have operating partners who focus on business performance improvement, the majority lack operating management strength and depth. This could be a game changer for a public company pursuing a buy-to-sell strategy and competing with private equity firms. Can you keep up with a steady stream of acquisitions and disposals? Private equity firms understand how to create and manage an M&A pipeline. They understand how many targets they must evaluate for each bid and the likelihood that a bid will be successful. They have disciplined processes in place that prevent them from raising bids solely to meet an annual investment goal in deals. At the same time, private equity firms are adept at selling businesses, whether through finding buyers willing to pay a fair price, for financial or strategic reasons, or through successful IPOs. During the acquisition process, private equity firms develop an exit strategy for each business. Exit price assumptions are probably the most important factor in their target valuations, and are constantly monitored after deals close. A public company must assess not only its ability but also its willingness to become an expert in the sale of profitable businesses. If you can confidently answer yes to those 3 questions, the next step is to decide on a portfolio strategy. In principle, flexible ownership appears preferable to a strict buy-to-sell strategy because it allows you to make decisions based on current assessments of what will create the most value. However, a flexible ownership strategy always risks complacency and the temptation to keep businesses for too long. After all, a stable corporate portfolio necessitates less effort. Furthermore, a flexible ownership strategy is difficult to communicate clearly to investors and even your own managers, and may leave them unsure of what the company will do next. We anticipate that financial firms will opt for a buy-to-sell strategy that relies more on financing and investment expertise than on operating skills, resulting in faster portfolio churn. Flexible ownership is more common in manufacturing and service businesses. We believe that companies with a strong anchor shareholder who owns a large percentage of the stock will find it easier to communicate a flexible ownership strategy than companies with a diverse shareholder base. Joining the fight. The phenomenal growth of private equity has sparked heated public debate. Some argue that private equity is essentially about asset stripping and profiteering, with private equity investors, partners, and managers taking unfair advantage of tax breaks and regulatory loopholes to make unseemly sums of money from questionable business practices. Others argue that private equity is a generally superior method of business management. In our opinion, the success of private equity firms is primarily due to their unique buy-to-sell strategy, which is ideally suited to revitalizing undermanaged businesses that require a period of intensive care. Private equity has benefited from an unfair tax advantage, but this is due primarily to corporate capital gains taxes, rather than private equity firms' use of interest payments on debt financing to shield profits from tax. After all, public companies can use borrowed funds to fund acquisitions and other investments. Private equity partners' high rewards reflect the value they create, but also investors' somewhat surprising willingness to invest in private equity funds at average rates of return that appear low in relation to risk. We believe it is time for more public companies to overcome their traditional aversion to selling a profitable business and seek opportunities to compete in the private equity sweet spot. Such a shift would be accelerated if the United States and other governments followed Europe's lead in leveling the tax playing field. The opportunities provided by a buy-to-sell strategy could then benefit public companies. Investors would benefit as well, because increased competition in this space would result in a more efficient market in which private equity partners would no longer have such a strong advantage over the investors in their funds. Like, subscribe, get notified.